Today, we are deconstructing the complex and, frankly, conflicting signals surrounding the automotive manufacturer Saris. We're going to dig into the deep disconnect between how the market sees the company and how it's actually performing. So right at the center of this is what we're calling the Sears paradox. On one hand, you have the market view. The stock price is down, and major analysts are downgrading. But on the other hand, you have the fundamental view. Sales are absolutely surging, and year-to-date profit growth is incredibly strong. This is the core conflict we're going to unpack.
And this leads us to the big question, right? Why? Why is there such a huge gap between what the market seems to believe and what the company's actual performance data is telling us? Well, throughout this analysis, we're going to dive into the data to find the answer.
Here's how we're going to break it all down. We'll start with the market's short-term concerns, then we'll pivot to the fundamental strengths. After that, we'll look at the strategy behind their recent spending, and we'll wrap up by looking at what's ahead, both the opportunities and the risks. All right, so first, let's really get into the market side of the story and understand what's driving this negative narrative. Now, if you look at the data, the underperformance is pretty stark. Between early September and mid-November, the broader market, the CSI 300, was actually up, but Saris's stock went the other way. That's a relative underperformance of over 7%, which tells us the pressure here is very specific to the company itself, not just a symptom of the wider market. So what's spooking investors? The analysis points to two main drivers. First, there was a huge capital raise in Hong Kong. This created some short-term technical pressure on the stock and, naturally, some concerns about share dilution. And second, you have big names like UBS and Citi lowering their ratings. And their reasoning? A small dip in the third quarter profit, which they tied to rising expenses. But, and this is a huge but, that is only one side of the coin. When we pivot from that market sentiment and look at the underlying business fundamentals, a dramatically different picture begins to emerge. You see, despite that Q3 noise that had analysts worried, the bigger picture shows remarkable profitability. We're talking about a net profit of over 53 billion yuan in just the first 3 quarters. That's a jump of more than 31% from last year, and it continues this incredible turnaround story that really started back in 2024. And this next point is absolutely crucial because it's not just about profit, it's about the quality of that profit. This DuPont analysis shows a major strategic shift. You see, back in 2024, their high return on equity was really fueled by high financial leverage, which is a risky game. But now, they've significantly cut that leverage. It's a deliberate move to de-risk the balance sheet and build a much healthier, more sustainable financial foundation. And they're deploying this financial muscle in an industry that's going through, well, a pretty brutal shakeout. We call this a K-shaped divergence. It's where a few top players, the upward arm of the K, just take off and grab massive market share, while everyone else on the downward arm struggles or fails. And you really don't have to look far for proof. Just look at these recent sales numbers. Cerise, with its Ito brand, is on that clear upward path, a massive year-over-year jump in sales. At the exact same time, major competitors like Li Auto and BYD's plug-in hybrid segment saw sharp declines. Cerise isn't just growing, it's growing at the direct expense of its rivals. So where does this powerful competitive edge come from? It's all about their incredibly deep, multi-layered partnership with the tech giant Huawei. It started with technology, then it evolved into sales channels, and now it's deepened into an actual equity and intellectual property partnership. Series has invested in Huawei's car unit and even acquired the Ito brand trademark. This creates a strategic moat that is just so much deeper than a typical supplier relationship. And this right here, this brings us right back to the heart of that paradox we started with. It turns out those high expenses that have the market so worried are in fact the very engine driving the fundamental strength we've just been looking at. The core idea here is that the market is simply misreading the situation. That little dip in Q3 profit wasn't a sign of weakness or an operational failure. It was a deliberate, strategic choice to press their advantage and win the market. And the third quarter numbers lay this out perfectly. You see, revenue grew by a very healthy 15+%. But instead of letting all of that drop to the bottom line, the company consciously chose to reinvest those gains back into the business, which resulted in that slight dip in net profit. So where exactly did that money go? Well, it wasn't just random spending. It was highly targeted. A huge chunk went into R&D to deepen their tech leadership with Huawei.
The rest was poured into aggressive sales and marketing to build a premium global brand and to win that K-shaped battle for market share decisively.
Okay, so with that strategy in mind, let's look forward and see how this is all meant to shape the company's future, looking at both the growth drivers and the potential risks on the horizon.
The next big chapter for Sears is clearly globalization. They've already laid the groundwork, and now, critically, they have the money to do it. That recent 13 billion yuan capital raise, it's explicitly for building a global sales network. The target is to launch in key overseas markets by 2026. This is their clear second growth curve.
Now, a common question is, what about all of Huawei's other car partnerships? Does that dilute their focus on Seres? Well, this matrix suggests the opposite. Huawei's strategy seems to be about segmenting the market, not creating internal competition. And within this whole alliance, Seres has a unique protected spot. It exclusively owns the very lucrative premium SUV segment and has, by far, the deepest level of integration.
Of course, no objective analysis is complete without looking at the risks, and there are some significant ones to keep an eye on. Competition is only going to get more intense, which could lead to price wars. Expanding overseas opens them up to geopolitical risks like tariffs. There's also the long-term strategic risk of being so dependent on a single partner. And finally, there's always the risk that this period of heavy investment goes on longer than planned.
And all of this really leaves us with one final and I think profound question, not just for Sears, but for the entire EV industry. In this incredibly capital-intensive race for dominance, what is the true price of securing market leadership? This tension, this conflict between short-term profits and the massive cost of long-term strategic positioning is truly the defining challenge of our time in this sector.